Hi everyone, thank you for attending our webinar today on why the 60-40 retirement strategy doesn't really work in a low yield environment and how financial advisors can really focus on implementing better retirement strategies to attract and retain high net worth clients. My name is Rajiv Rebello. I'm the Principal and Chief Actuary of Colva Actuarial Services. We're the math advisors to financial advisors, and we're really going to show you here in this webinar on how to implement better after-tax, after-advisory fee retirement solutions for your clients to help you grow your business and implement better strategies. So I won't spend too much time talking about my background, but we're essentially an actuarial firm that helps improve after-tax, after-advisory fee returns for RIAs and family offices by just focusing on implementing more tax-efficient solutions. So let's go ahead and just jump right into it. Why does the 60-40 retirement strategy no longer work in today's current low-yield environment? Well, the first issue, right, is that current bond yields are at historic lows. And the problem with this is that as you're nearing retirement, you're allocating a larger percentage of your client's portfolio to bonds. So when bond yields are at historic lows, they're no longer providing the gross yield necessary to offset the equity risk and provide diversification, right? So that's the first issue, is that current bond yields are at historic lows. The second is that bond gains are highly taxable, right? So if you're a high net worth client living in a state with a high income tax, a large portion of those gains, which are already low to begin with given the low yield environment, they're losing to taxes. On top of that, if those bonds are in a taxable account and you as the RIA are charging your AUM fee on an after-tax basis, the clients are getting really nothing out of that bond portion of the portfolio. And we'll go over the math in a second here. And finally, the last 2 points are that in this current low yield environment, when interest rates do rise, clients will absorb heavy losses to their bond portfolio depending on how long the term of the bonds they're invested in. And we'll talk about that in a second. And finally, typical strategies like asset location, which can kind of help high net worth clients deal with some of these problems in a higher yield environment, don't really work in the low yield environment. On top of that, these high net worth clients are phased out of contributing to traditional tax advantage retirement plans like the traditional or Roth IRAs that could help them with this issue, right? So these are all the reasons why the 60-40 retirement strategy no longer works in this current low yield environment. So again, bond portfolios in a low yield environment pose more risk than diversification benefits, and we need better strategies to attract and retain high net worth clients. And that's what we'll be talking about later on in this presentation, or what are the better retirement strategies that you can implement to actually help your clients meet their goals in today's new low yield environment. So now let's kind of talk about why kind of paying an AUM fee on a low yielding taxable bond doesn't really make sense for high net worth clients. We'll just briefly go through the quick math here. So again, as we talked about, as clients near retirement, advisors typically choose to allocate a larger portion, up to 40% of clients to a short-term bond portfolio like the AG, simply to avoid interest rate risk, right? You want to avoid sequence of return risk, and that's why advisors are typically doing a higher bond portfolio allocation as they near retirement. But obviously, in today's low yield environment, this isn't really providing the diversification benefits that it used to in a higher yield environment. And so let's just go on over the math real quick. Again, the gross return on the bonds we're just going to assume is 2%. In reality, right now, the gross returns on bond benchmarks like the AG are significantly lower than 2%. They're closer to 1%, but let's just use 2% as a math example to make some of the math here easy. The tax rate, let's assume it's 50%. Let's a high net worth client living in California or New York, and then the advisory fee is 1%. So let's walk through the math of what they're actually getting, right, for choosing to invest in bonds and walking away with. So again, on an after-tax basis, they're getting, here's the gross yield, and they're losing 50% of that to taxes. So now they have the 1%, right? But then they're paying the advisory fee of, let's assume that's 1% for simplicity's sake. So again, on an after-tax, after-advisory fee basis, they're making nothing because the after-tax return of 1% is being reduced by the 1% AUM fee that the advisor is charging, right? So they're walking away with nothing, even though they're taking all the risk, right? They're taking the credit risk, they're taking the liquidity risk. So this is the issue with kind of the bond portfolio, or the increasing bond allocation in today's environment, is that they're essentially getting nothing and taking all the risk. So the last thing I want to talk about with this is, again, the ag is significantly less than 2% right now. So what's going to happen, right? What's going to happen in today's low yield environment, and why is this an issue that RIAs really need to focus on addressing? It's because eventually they're going to do the math, right? They're going to do the math, and they're realizing that if you're a high net worth client, you're losing just too much of your net return to the advisor on the bond portfolios, and it doesn't really make sense anymore for clients to give, or high net worth clients to give the bond portfolio of their allocation, or the bond allocation, or the portfolio rather, to RIAs, because it just doesn't make sense on an after-tax, after-advisory fee basis. So let's kind of just look at some of the assumptions here and why that no longer makes sense. On the equity portfolio, it still can make sense. Again, let's assume it's a 60-40 portfolio, so 60% are in equities. We're going to assume the gross return is at 8%. Again, the historical return has been a little bit higher than that, about 10%, but we'll use 8% for this example. Again, the marginal tax rate is 37%. The RIA's after-tax advisory fee is 0.75%. So I'll skip the math here and just jump to the end. The after-tax, after-advisory fee return is 4.29%, right? So if we actually look at, well, what percent of this net return did the client lose to the advisor? On the equity part of the portfolio, it's not bad. It's about 17%. However, when we look at the bond portfolio, it's a completely different situation, right? Again, we're going to assume 2% is the gross yield on bonds, 50% the marginal tax rate. We'll use a lower 0.75% after-tax advisory fee. But what happens even using this is that on an after-tax, after-advisory fee basis, right, the client is only getting 25 basis points, but the advisor is getting 75 basis points. So the advisor is actually making 3 times what the client is making. For taking all the risk. So as we said, high net worth clients will eventually realize that this math doesn't really make sense, right? The advisor is getting 300% just for managing the assets than they are for taking all the risk, right? So what is the point? Again, high net worth clients will eventually realize that it's better just to leave the equity portfolio with the RIA. That way they get all the financial advice that they need. But they can invest the bond portfolio, 40% of their assets, right, into a low-cost bond index fund themselves. So they're either going to do this, they're going to take the bond portfolio away from RIAs, which means that, again, you're losing 40% of your AUM, or they're going to take the entire portfolio to an RIA that implements better tax-efficient, fee-efficient solutions for them. And that's what we're here today to help you out with, is how do we create those better solutions? What are those solutions, and how can we help you implement them into your practice to both retain your current clients, but also use this as a way to market better tax-efficient solutions to high net worth clients who are not getting this at their current financial advisor, or don't realize that important tax planning is really a crucial part of financial planning in today's low yield environment. So again, what all advisors are probably familiar with are doing Monte Carlo simulations. So we can actually do the simulation at different equity bond portfolio compositions and see, well, what has the better chance of meeting a retirement goal. So we'll assume that the retirement goal is 4% of their assets. The client wants to take out 4% of their assets at different equity bond portfolio allocations. So which is better? Should they go 100% equity? Should they do the 60-40? And we'll actually see that when you do your simulations on an after-tax, after-advisory fee basis, they're actually better off investing in a 100% equity portfolio than doing the 60-40, right? So even the 100% equity portfolio only gives them a 42% chance of meeting this 4% retirement goal in today's low yield environment. But the 60-40 is at half of that. They only have a 21% chance of meeting their retirement goal. So there is really no value in a low yield environment of clients using bonds as a diversification method, right? Because on top of this, the yield is too low. They're paying too much in taxes. And what's not even being included here is that if interest rates rise in the future in 5 to 10 years, these bonds that they're invested in today will take losses, right? So it's a serious issue that financial planners need to keep in mind. And the high level point here is that in a good economy, you can just focus on asset management. It's okay. You can stick your client in the 60-40. You manage the client relationship. You don't have to be as concerned with the downside risk here, because The equity returns are doing fine. The bond yields are significantly higher, so providing better diversification against your equity risk. So just the asset management approach is fine. However, in the bad economy or a volatile economy, you need better financial planning tools at your disposal, because clients become overly concerned about risk and they want strong financial planning as they near retirement. Because bond yields are low, they need better financial planning solutions. So now is really the time for strong fiduciary financial planners to demonstrate their value add in a volatile, low yield environment. And that's what we're here again to help you out with today on this webinar.